This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in raising funding for your startup? For your next fundraise, consider 10 Capital Syndicate Platform, an online portal using a special purpose vehicle. The Syndicate Platform allows for online investment and access to over 12,000 accredited investors. Log into the 10 Capital Syndicate Platform to find your next investment. To learn more, go to 10capital.group/SPV. Hello, this is Hall Martin with Investor Connect. Today we're here with Ryan Falvey, co-founder and managing partner at Financial Venture Studio. Financial Venture Studio invests in the best early-stage fintech companies and provides the access and insight founders need to build transformational companies. Ryan, thank you for joining us.
Thanks for having me.
Great. Can you tell us more about your background and before you started investing in early-stage companies?
You know, I've always worked in financial services and technology. I worked in emerging markets earlier in my career and did a lot on mobile banking and mobile payments platforms in a lot of developing markets. And then I worked for a bank for a while, and then had a really interesting opportunity where I kind of got my start investing, working with a nonprofit that had received a grant from JP Chase to invest in and support early stage fintech companies. And so that's kind of how I got my start, and that portfolio did really well and took some of the learnings we had through that and started this company in early 2018.
Great. So what excites you right now?
Fintech broadly, it's a great part of the market to be in. We've seen, fortunately, with the last year and a half of COVID, just an incredible acceleration of trends that we've been watching for the last decade around consumer adoption of digital financial tools, of new and innovative ways for people to manage their money, to spend their money, to send it. And we're now seeing that fruition really at every stage of the market. So we see a lot of really interesting stuff in consumer. There's a lot of new tools for small businesses coming along. We're increasingly excited about some stuff for larger enterprises with atypical in venture. And then there's a lot of infrastructure that's being developed now and built, which I think is going to really just lead to a compounding wave of more and more innovation in this space.
Great. Well, let's talk about the industry. How do you see it evolving from here?
Well, I think we're going to continue to see growth. I know we've got a number of companies in the public markets now that have recently come to market. We've got a bunch in the pipeline. I think that those are actually addressing I believe it or not, one of the criticism that people had of fintech a year and a half ago was that there's no exits in the space, that there's no acquisitions. I think we've answered that criticism pretty strongly here and over the last year. And so we really see a real flood of capital almost across every stage, from where we sit, the seed stage, and almost getting increasingly more pronounced as the companies get closer to going public. So that's leading a lot of founders to start new businesses. It's a great time for us to be an early stage seed investor because we're seeing more companies than ever. The companies tend to be more sophisticated. They're tackling more complex parts of the market. They're growing faster earlier. And so it's just a really exciting time to be looking for early stage innovation.
Well, great. And so what do you think we're going to see in the way of consolidation here?
Yeah, I don't see as much, I don't see kind of abnormal amounts of consolidation. Recently, we saw this acquisition of Afterpay by Square. That was a really big deal. I think that's arguably probably the biggest deal we've seen in fintech. But, Square is now a huge company. People also forget that company is probably about 4 times as big as it was, a year and a half ago. And so, you look at the numbers there, it's a $200 billion company acquiring a $30 billion company. That's not too abnormal. So I think we're potentially seeing more about really late stage activity. We've seen a lot of early stage activity for the last year. And we had more acquisitions in the first half of this year than we had, in the previous 2 years within our own portfolio. That consolidation is not, is often driven by a larger firm really trying to add more product functionality to what they're building and working on. And within our own portfolio, So the example is Harvest, which was recently acquired by Acorns, which is in the process of going public, via a SPAC. And Acorns has a solution that helps consumers save, and Harvest had a solution to help consumers avoid and fight bank fees. And so that's kind of a natural fit for that company as they go and try to diversify their revenue stream and find more points of engagement with their consumers. And so, and I think frankly that's a very similar story to Square's acquisition of Afterpay. You have a new way that consumers are using or financing purchases at the point of sale. And Square is obviously very invested in the point of sale. And so that makes a lot of sense that they'd want to be on that side of transaction and build more relationships with consumers. And so I think that those trends of looking to build, the quote super app of fintech are going to continue to transpire.
So what do you think is the biggest change we'll see in this space in, say, the coming 12, 24 months?
That's a good question. It's hard to pick on a single thing. I'd say that I just expect it to get bigger and bigger. We're seeing no slowdown in growth in these companies. Years ago, I was at an industry dinner, and people asked, "So what will happen in 10 years?" And I was like, I think probably 2016 maybe. And I said, I think one of these, big banks, one of the big four or five banks is going to fall out of that, get replaced by a fintech company. I think I was probably being too conservative. I could see that happening sometime next year.
What do you think is the impact of DeFi on this space, and when will that happen?
I think DeFi is still pretty early in its evolution. There's a lot of promise there. We're certainly seeing a lot of energy, entrepreneurial energy, and a lot of attention focused on it. One of the challenges is that it is still relatively limited in the number of people who are using these products. A lot of regulatory uncertainty as well, which I think is certainly in the US is kind of hampering adoption more broadly. It's an area we look very closely at, and it's frankly an area I'd like us to be smarter in and to get to really try to understand what the potential is there. But I do think we're still looking at potential for the most part. We're looking for businesses that right now that create kind of on-ramps for DeFi versus traditional fiat currency, and finding more elegant ways to integrate some of the functionality you see in DeFi into, I would say, traditional financial products and products people understand kind of intuitively. And we're seeing progress there, but I think we still got a little ways to go.
Great. Well, let's talk about SPACs. Are any of your early investments going public through a SPAC?
We actually have two companies currently that are in the process of going public via SPAC. One was a company we invested in very early. We were a seed investor back in the day called Dave, and it's a product that helps consumers avoid overdraft fees, and this has really grown to create a whole broader product suite around it. The company has grown, really been a remarkable growth story since that first investment, and is announced it was going public via SPAC at the end of May, early June of this year. And very excited about that. The company has not actually raised a ton of capital in its life cycle, and so this will be a real opportunity for it to see what it can do. And I'm excited to see the company go public via. And I think the SPAC is a really good tool for a lot of firms to go public. The other one is Acorns, which we were fortunate enough to get some ownership in via the acquisition of one of our portfolio companies. And again, similar growth story, products that helps consumers save and put aside money and really try to help them build their financial health. And that company, it announced, shortly, again in the late spring, that they're going public via SPAC too.
So, what was the general logic for Dave? I believe they came out with a $4 billion valuation.
Well, I think the logic would be, and it's a effective way to raise money. I think for a company that when you're growing really fast, you do always want to look for more capital to help fuel growth. And a SPAC is an effective way to do that. And then once the transaction's completed, you have stock and the ability to more easily tap capital markets if necessary, both to fuel growth, for acquisitions. Obviously, it creates some liquidity for early investors. So I don't know if the logic of going public via SPAC or the traditional route is a lot different for a company. And I would just to say, as a disclaimer, I was not closely involved, wasn't part of management discussions or the board discussions behind the SPAC, so I don't have any special insight there, or non-public insight. But I think this route is opening the doors for more companies to tap the public markets. than existed before. And so I do think it's a good thing for the innovation economy in our country.
Well, great. Well, you see a lot of startups and a lot of investors in this space. What do you find is the primary challenge that startups face in today's fintech space?
Within fintech, when I think about the opportunity set in fintech, what's really changed here over the last couple of years, or the last decade or so, is it's now possible for somebody to have an idea and a new way of thinking about financial services and launch that and really see if the market takes hold. No, that wasn't possible 20 years ago. You would have to get a bank charter and you have to be pretty well connected and have a lot of money to do that. And this wasn't something that like an entrepreneur by any conventional definition would be able to pull off. I mean, if you think about the stereotype of bankers, they're literally the opposite of entrepreneurs. And so what's happened with, I think, the rise of the consumer internet is it's really allowed a whole host of new innovation in the market. The reality, though, is that it's still as difficult to connect to that financial service ecosystem. It's still a heavily regulated industry. It still requires a great deal of sophistication in how you engage with regulators, policymakers, other potential partners. Typically you need another company to help hold the funds for you or help you move the funds, and those take relationships and networks. And so what we try to do with our companies that we invest in is help connect them to those networks and help them to be successful. And I think for the founders we work with, we're really trying to save them time and get them kind of the stage they need to be at more quickly.
Great. And then for the investors, what's the main challenge they face in today's market?
In today's market, it's just this pace of deal activity, and I've never seen anything like this. I mean, it's an incredible. There's a lot of companies out there. They're raising money more quickly and efficiently than ever before. You really need to be very involved in the market and closely connected to be able to see the deals when they're coming, and then you need to make decisions much more quickly than before.
Great. And then what's your advice for people, say, investing in SPACs? What do you tell them to do before they pursue that?
I'm not a public market investor. I wouldn't be able to give you really good advice on that. I mean, I've never invested in a SPAC. I feel like I'd probably just be generic, see who the sponsor is and their track record or something. But it's not a space that I focus on.
Well, then on the other side of that, what do you tell your founders about using a SPAC for their business? What should they do before they consider actually pulling the trigger on that?
Well, the key question is whether the company's ready to go public.
Mm-hmm.
It's kind of like like having a baby. Once you do it, you can't undo it. And so, you go public, you're a public company, and there's a lot more scrutiny. There's a lot more focus, and that's very important. And not every company, companies. I mean, the average company I'm working with has just been formed. I mean, there are a couple people, and so there's not that much changes in a couple of years. Usually, the company can be a lot bigger, but there's still a lot. You're usually, when these are working, are so focused on just like keeping it going, growing, and kind of keeping the wheels on the bus than focusing on a lot of process and reporting and compliance and those types of things. There's a lot of that associated with being a public company, and so it still takes a lot of preparation for a company to be ready to be a public company, whether they go via a SPAC or the IPO route. And so, I think it's a very small number of companies that make sense to go via any of those routes in the market. So far, I will say it does seem that both via SPACs and via the IPO market, we're seeing very, very sophisticated, very well-developed companies going public these routes. These are not low quality firms who just came out of nowhere. They generally have significant revenues. They've got proven management teams. They've got business models that are working. And so, I think it's still a pretty healthy market for the companies that are ready to take that plunge.
Oh, good. So in the last few minutes that we have here, what else should we cover that we haven't?
Well, I will say, one of the things we're trying to do right now is look for our next wave of companies to invest in. So one of the things we do is after we invest in the companies, we work really closely with them to try to connect them to that broader financial services ecosystem of regulators and policymakers, potential partners, investors, media, digital influencers, and other founders. And so we do that through this really structured kind of post-investment program. And to make sure we cast the widest kind of net possible, we run an open application process. And so right now we're looking for companies. So if you have an early stage fintech company or somebody who does, you should reach out. You can go to our website at www.finventurestudio.com or Google us. And there's just a link and it takes 10 minutes. And is something we do about twice a year just to make sure that we're really having as inclusive a process as possible. So I'd encourage anybody who's building in the space or is focused on it to apply.
Great. So how best for listeners to get back in touch with you?
So again, you can go to the website or you can reach out to me on Twitter. I'm Ryan_Falvey there. And I tend to be pretty responsive.
Great. Well, I want to thank you for taking time to join us today and hope to have you back for a follow-up soon.
Absolutely. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.